Hi, Peter Rose, founder of Longwood Currency Trading, and I wanted to spend a little time today. Well, actually, this is the first time I've used one of these stupid selfie sticks on a GoPro. I just got a GoPro, actually, so you'll have to bear with me if the GoPro slips and falls or you can't see my head or face or whatever. Anyway, it's such a beautiful day today. We're pushing toward the last week in May, and up here in New England, as you can see in the background, hopefully, maybe, the trees are starting to come out with their buds and things, and so it's a really lovely day. But I thought I would spend a little time today talking about a subject that is pretty relevant to everybody's trading, whether you're a long-term trader or whether you're a short-term trader, a scalper, as I am, and that's multiple time frame analysis. Multiple time frame analysis is important from the standpoint that regardless of your trading view, in other words, whether you're a long-term trader or whether you're a short-term trader, you have to use multiple time frame analysis in order to tell what the heck is going on. And generally, folks use 3 time frames. One, a long time frame, so that you can determine what the general trend of the market is. The next time frame down would be probably two time frames down from where you are, would probably be where you're looking at for your setup analysis and your risk and your rewards and all that sort of trading stuff that you need to know. And then you're down on the next time frame, which again is probably a couple of time frames below that, on your actual trading time frame, so that you can watch the price action. I actually have 4 that I use, and I'll get into that later because, again, as a scalper, I'm very short in my time frame. I really need current information. So you're going to have to take what I'm going to talk about, what I do as a scalper, and kind of put that into the context of what you do if you're doing long-term trading. I think that I'll probably catch a lot of flack for what I do, but scalpers as a whole take a lot of flack anyway. I mean, look, I was a real estate investor for 40 years. That's a long-term trade, and I understand that. I get that. I get that smoothing your risk and all that stuff out over the long term. But corresponding to that has to be the immediacy of the market that you're dealing with. In real estate, you can't just go, oh, geez, it looks like the market's going south, and I think I'll sell my property. I just got caught with that. My last building, I retired. I'm 70 years old. I retired several years ago and started selling off my real estate portfolio. I got 1 building left and stuck that on the market right as this COVID thing started. And so, I'll sit with that for 6 months or maybe longer before somebody decides to pull it off from me. But so but I've held that building for a long time. So your view has to change. Am I nervous because I have to wait 6 months? Well, yeah. I may or may not sell it for what it was worth before, because this crisis is really going to change our view of economics overall. But I can't get wound around the axle on it. It's only money, and as long as I got my health and family and everything, that's more important. Or here's my wife's garden starting to come out. I don't know if you can see this or not, but it's just starting to come through. There it is anyway. So as a short-term speculator, shifting my focus from real estate into the currency markets now, you have to change your view of your risk. That's the main thing, is your risk. So as a short-term speculator, as I've said on other videos that I've done, my mental stop is 8 pips. I'm out of there, and my targets are maybe 3 times that, but I grab maybe one time that. But I got a good win to loss ratio because I know what I'm doing in my particular area of expertise in the scalping. So I make money. That's fine. But let's get back to the multiple time frame analysis. So for me as a speculator, I'm going to use the 4-hour chart. I'm going to use the 15-minute and the 5-minute. Those are the 3 things. I'm going to get my trend from the from that 4-hour chart, and I use the 4-hour chart because that's the one where the banks and the big guys are looking at as to what those of us that are in the retail traders, which is only 15% of the market, that's where they're trading, or that's where their trading signals are showing up on. Most small retail traders are playing with a $3,000 bank. They're not trading daily charts, and they shouldn't be, because they just don't have you just can't take a 300 pip loss. You can't take the inevitable 6 losses in a row that you're going to get hit with when you're short stacked on a longer time frames. So you're down on that 4-hour chart, pretending that you're playing with the big boys, and okay, that you do whatever you want to do. But the large institutional traders know that they're not short stacked, and they're going to look at that 4-hour chart to see what the herd is doing, and they're going to take you out. But that 4-hour chart does determine the trend, because if everybody is moving in one direction, the retail traders, the general price action that you see is created by the retail traders until boom, something goes off. That's the institution taking a dump on everybody and clearing out the wood pile. So, but it's that 4-hour thing that is going to dictate over the long run where the institutional traders are going to try to take their price. They got a $2 billion order that they need to fulfill. They can't just drop that $2 billion into the market. They've got to know where the liquidity is. And so, if my object is to sell, I've got to establish that, run the price up, wipe everybody out, bring it back down and cash out, run the price back up. It's that kind of action that's going on. But that's manifesting what that 4-hour action is doing over a several-day period of time, because that's how long it's going to take for the institutional trader maybe to unload $2 or $3 or $4 billion worth of client orders. So that's why I use that as my trend time frame, the directional trend of that time frame. And then I come down off of the 4-hour down onto the 15-minute, which is a good representation. I'm trade pound dollar, so I've got a 15-minute ATR of, I don't know, 7, 8, 10 pips, something like that, maybe a little more, 15 pips. An ATR on a daily chart might be 100 or 120 pips, so you divide that by 4 and you come out with 50, 60 pips I'm sorry, not 50 or 60 pips. You get to divide it by more like 8, so you get down there around that average level of, call it 10 pips or something like that at the 15-minute chart. Then you come down on the 5-minute, and your ATR there is probably running you, let's say you're going to run 5 pips on that, on that time frame. You might get 7, and the 15 may be a little bit higher. You just have to look at what the price action is doing on any given day and kind of smooth and average all that stuff out. But the main thing is that 15-minute chart, how many 15 minutes are there in 4 hours? So how many bars are you going to get in a 4-hour period of time? Expand it out now that you can look at and see how the transactions are actually taking place, so that you can reasonably set where the intermediate congestion zones are. So you can kind of figure out, wow, this is a pretty good time. I've got some velocity or some momentum of price action going in this direction, and it looks like I'm at the far end of that, so it's going to probably come reverse and come around. It's probably got enough momentum to take it down X number of pips, and you can see that in the 15-minute time frame. And so you can base over a several-hour period of time that you may be in a trade, even a trading as a scalper. You got to look at what may happen. You may be in there for a couple hours. And that's gonna give you a better idea of what the potential of that trade is. If I'm looking at a 15-minute chart, I could see profit targets that are 50 pips away. Now, I'm not going to trade on a 5-minute time frame and try to scalp for 50 pips because that just doesn't make any sense. I'll be scalping for 5 pips or 3 pips or 10 pips. My immediate goal that I'm shooting for, that I can see clearly on that 5-minute chart, is going to be 10 or 15, maybe 20 pips. But I get the longer term view on that 15-minute chart. So you've got 3 5-minute periods and a 15-minute time frame. So you got 3 bars on that 5 minutes that'll print to get your 15-minute bar. And so I can say I'll be in this trade for 45 minutes or so, or 30 minutes. Look, I've been in trades for 10 seconds, but you got to be reasonable about this stuff, because momentum has a lot to do with it. Now, I'll get the momentum later on that 4th time frame that I'm going to be looking at. So the 4 hour is going to be where I determine what my trade is, what the trend is, the overall trend of the market, what that's going to be, and then I'm going to look at the 15-minute to do my risk-reward analysis, and where my setup analysis is going to be, and also my exit plan, what I'm going to do. And look, this is not a big deal. I mean, it doesn't take you 45 minutes to figure this shit out. All you got to do is look at the chart, and it's going to tell you what to do. You need a little bit of experience. But after a while, you just look at the thing and go, yep, there's a potential trade here. And hey, this is how I do my analysis. This video is not about how I do that analysis. It's only to tell you where I do it at. And so I'm doing that at that 15-minute time frame. So now I jump down onto the 5-minute, and when that 5-minute is moving the correct way, I'm in. I take my trade. Now, if the trade starts to go against me right away, I've got my mental pip stop. I don't set limit orders because that just makes me think, and it makes me hope. Oh, I hope it doesn't go all the way to my stop. I'm just going to hang on to it. And then the fucker plunges, 20 points below that because some bank dumped on you, and you're out and you're gone, and your whole risk-reward process as a scalper is screwed up. So you got to really look at this stuff carefully as you're scalping through all of these variances in what can happen. But if it's going down, I've got that mental stop at 8 pips. As soon as that price even starts to get near 8, as soon as I can see it's not moving in my direction, and I can generally, 5 or 6 pips, and you really know this is going to continue down for 8 or 10 or 15 pips, and then it's going to turn around or it's going to go up because I go short term. I'm primarily a short scalper because stuff moves down faster than it goes up. That's just a basic law of physics, and it's applicable to transactional vehicles as well, such as the currency markets. So regardless of that, if it starts to go against me, man, I'm out. I'm just out. I'm out. Okay, out. If you have that one rule, you'd be all set. But what if it goes in my favor? My projected profit target is, as I said, 20 pips, let's say. And the thing starts moving up. Okay, I've got a profit target at 20 pips. I don't expect to get 20. I mean, on a really good day, I'll get that 20 pips before it rolls around and it starts to head back down. So my number one thing on that process is I've got to determine when prices run out of gas before it gets to the point where it's rolling back against my stop, my mental stop, either to a break-even point where I get out of the trade, or it made it 3 or 4 pips up, and now it's flipping around and going down, and it's heading toward my 8 pip mental stop, and I just get out. So I take a lot of trades where I get out at a 3 pip loss or a 5 pip loss, and the reason for that is because it's already gone up 5 or 6 or 8 or 10 pips, and then it swung back around and started to come back down. I get out. I get out before that. If I'm stupid and I sit there and I let it go 3 or 4 pips against me, that's my bad. Because what I do, that fourth time frame that I'm looking at, hold on to your butt now, is the 5 second. Because I'm looking at the velocity of price action at that 5 second chart. And when those moving averages start to arc in the wrong way, I'm out. So let's say I'm short. Price is moving in my direction and it's going down. It's gone past the my 5 pip profit target that I'm happy with. If I get 5 pips, that's $5 a thousand. That's a 0.5% win. I mean, you can't pass that up. So once it goes past that $5, I'm going to lock that 5 in. I can't get out if it goes back to the $5 point. But once it goes up around 8 or 10 pips in my advantage, I can at least go to break even on the trade. Now it keeps going. I got a profit target of 20, and it's at 15, it's at 16, it's at 17 pips toward my 20, and I'm looking at the 5 second chart, and I see that price is starting to chatter. You know what I mean by chattering, okay? It starts to chatter. And the longer it starts to chatter, the more those moving averages, which are 8, I primarily rely on an 8, 21, and a 55. So when that 8 times 5, 35 seconds, when that line starts to gradually flatten out, well, what do you think that means that price is doing at that point? Well, it's starting to turn around. And so I just exit the trade and I get out. I'm not going to wait around for it to lose more. I'll take the 15 pips. I'll take the 5 pips instead of trying to shoot out at the 20. But you got to have some kind of gauge to say, this thing has run out of steam. Where do you think you're going to see that first? On the 1 hour chart? No, you're going to see that kind of thing manifesting itself on the 5 second chart. The 5 second chart's the dog and everything else is the tail. What happens on the 5 second chart is more likely to be transmitted then up to the 1 minute, to the 5 minute, to the 1 hour. So the guy that's sitting there at the 1 hour, he's gone 40 pips. I'm out with a loss of maybe 5 if I haven't been able to get out in a profit standpoint. So I can do that many, many times a day, and I just figure it's a lot safer to do it that way. I need another cup of coffee. I'm Peter Rose, founder of Longwood Currency Trading. Have a great day. Have a great trading day. See you around.